Brian, this is something that, again, as I pointed out, since the days of the great financial crisis, banks have had to focus especially laser on. What exactly, in your mind, happened with regard to oversight here, and what exactly do banks like NYCB do to restore that trust that Leslie mentioned?
Well, usually when you hear an announcement like this out of NYCB and an internal review underway, I think you mentioned earlier in your broadcast, you almost always are going to hear more bad news coming out of it. So unwise to sort of speculate at this time, maybe what might that bad news be. But when it does come to credit risk, whether you're dealing with customers of NYCB or the customers that I dealt with when I was the chief risk officer at Discover, usually more information is better. And that's the case with this new rule that's coming out from the CFPB regarding open banking, and that it will provide more information for lenders to be able to assess the credit risk of their consumers.
What's interesting about this is, by its own admission in these regulatory filings, as Leslie points out, it was some of the lack of internal controls and risk assessments around that lending practice within the bank that has kind of led to what could be further details to emerge about what's going to happen down the line at NYCB. What exactly will these proposed transparency rules do to help those lenders make better decisions about lending? And by extension, how can lenders be a little bit more trustworthy with regard to sticking to some of those rules to make sure that these banks don't face this again in the future?
Yeah. So what these new open banking rules will do is going to be great for banks and great for consumers, because what these rules will do is it will allow consumers to safely and securely share information with banks that will allow them to make more fair and more informed underwriting decisions. And the specific information that this rule is going to call on banks to share, and we expect the rule to be finalized sometime this year. And basically think about the information you as a consumer get on your checking account or on your credit card, all that information that's in those monthly statements, in addition to the information that they might send you around the terms and conditions. And so this will be information that you'll be able to safely and securely share with other companies. And by doing so, I can see three benefits that will occur for consumers. One, it'll be easier to switch banks if you want to, because you'll be able to take your information with you. That'll make banks work harder to keep your business. Two, it'll be easier to get approved for a credit card or a loan, because this information that's in your account, it has to do with your actual income and expenses. It's information that's not currently in the credit bureau reports, which a lot of banks use to underwrite consumers. So it's what we call orthogonal information in the risk business, highly valuable new information. And then third, it's going to make it easier to manage your money, because these open banking regulations will enable this data sharing and will enable, I think, a new wave of money management services to come out to help consumers manage their money. So it'll help consumers, and also then it'll help lenders by allowing them to make more informed decisions.